CFDs tax treatment. Want to know how income tax is charged on CFD transactions? There is much confusion surrounding CFDs and how they are taxed. Some say they are highly speculative forms of gambling and therefore not subject to tax. Others say they are similar to other financial derivative products and are treated like any other investment. For most people, CFDs are treated using the capital gains provisions. A CFD is a contract, and a contract is an asset for tax purposes, the same way a share is. In this respect, losses should be treated as capital losses and offset against any other capital gains. Therefore, losses incurred on CFD investments would be available for offset against other gains in the tax year, for example, gains on share disposals. Just work out your profit or loss for the year and deduct your annual exempt amount. If you have any excess losses for the year, you can carry this forward to deduct against any future chargeable gains. Thus, the income for tax purposes is the net income calculated by summing up all your gains and taking away all your losses. Realisation will generally occur at the time the CFD is closed out or otherwise expires. Note that expenses such as platform fees, financing charges and internet access may be deductible, thereby reducing your taxable income. Also, should you treat your profits from trading shares as ordinary income, which most people don't, then you can treat your contracts for a difference trading as a business loss and offset against other ordinary income. Having said this, the tax treatment can be a grey area, especially if you live in Australia. The Australian Tax Office seems to take the view that contracts for differences are essentially contracts of speculation, and that you're basically gambling that the underlying share will either increase or decrease in value. If this is the case, any capital gain or capital loss you make from a financial CFD will be disregarded under the CGT gambling exemption provision. Another point to note, if you live in Australia, is that there are no franking credits in relation to CFDs, and the 12-month capital gain discount also does not apply. In any case, always get in touch with a tax advisor in relation to such matters, as your specific situation may be unique and not covered by the above guidelines. Are CFDs exempt from tax on dividends? Returns from dividends on CFDs are subject to tax. Normally, the dividends on UK shares are quoted and paid net of basic rate tax. CFDs are exempt from stamp duty because they do not involve the trader purchasing shares. But generally, CFDs are not treated as bets, at least in the UK, so any profits from them will be liable to capital gains tax, unless they are held in a tax-efficient pension like a UK SIPP. That's why when a share goes ex-dividend, you'll usually be credited only around 90% of the dividend income. So if the company pays a 10p per share dividend, you'll get 9p. In any case, before doing anything, speak to your registered accountant or tax advisor. If it helps you to minimise your exposure to higher taxes, it may be the best couple of $100s you can spend.